CI&T for Q2 2026 missed bottom line consensus, but a beat on the top line. Actual revenue came in at $142.82 million, beating the expected $140.05 million. On the bottom line, actual adjusted diluted EPS was 7 cents, missing the 9-cent consensus, with GAAP EPS coming in at 5 cents. Looking forward, guidance for Q3 revenue is expected to be at least $145.7 million. Full year 2026 revenue guidance was actually raised to a range of $566 million to $578 million, while they maintained their adjusted EBITDA margin target of 15 to 17%. Despite that raised guidance, shares fell 6.04% in after hours, trading to $3.42. So for this deep dive, we are looking at CI&T's Q2 earnings report, management commentary, and a stack of Wall Street analyst notes, from Wedbush to JP Morgan. Our mission today is to figure out if this company is a falling knife or a misunderstood pioneer. Because you really have to look at this dynamic and ask yourself, how does a company reinvent the way software is built, post its 7th consecutive quarter of double-digit organic growth, actively raise its full-year revenue guidance, and still watch its stock get punished by Wall Street immediately post-market?
Yeah, it's a great question. And the answer really lies in, the friction between their top-line momentum and the bottom-line reality.
Right.
To understand the disconnect that caused that after-hours sell-off, we first have to look at the underlying mechanics of their revenue generation, because objectively, the demand for their services is incredibly robust right now.
21.9% organic year-over-year revenue growth is nothing to sneeze at.
Exactly. Even if you strip out the noise of currency fluctuations, it's still a highly respectable 14.1% constant currency growth. But when you look at the geographic distribution of that revenue, that's where the narrative starts to shift.
Yeah, it gets a bit lopsided.
It does. Latin America surged an impressive 32.1% year over year, and what they categorize as new markets, that grew by 26.3%.
Okay, let's unpack this. Because 32.1% growth in a single region is massive.
Absolutely massive.
But it immediately begs the question of what the core North American market is actually doing.
Right.
If Latin America is scaling that aggressively, but North American growth slowed down to 10.2%, we're looking at a decelerating primary engine. Are they firing on all cylinders or just running one engine really hot?
Well, management cited the timing of contract renewals as the reason for that North American slowdown.
Right, the classic seasonality excuse.
Yeah, they framed it as a temporary issue, essentially saying, the contracts are still there, they just didn't hit this specific quarter's ledger. But it's totally fair to be skeptical when growth slows in your most capital-rich market while emerging markets surge.
Right, exactly.
And that skepticism is warranted. The industry breakdown provides much better clarity on where the actual enterprise capital is flowing right now. The divergence across sectors is incredibly stark.
Yeah, the tech and telecom numbers were wild.
Unbelievable, right? Tech and telecom revenue absolutely exploded, up 67.8% year over year. Financial services also saw massive growth, coming in up 36.0%.
Wait, 67%? Those industries are in an absolute arms race for digital transformation right now.
Exactly. They're panicked about falling behind on AI integration. So they're just flooding IT consultancies with capital to rebuild their legacy system.
Which perfectly explains why consumer goods declined by 8.6%.
Exactly.
We're basically looking at a deeply bifurcated economy in these numbers. Infrastructure and capital-heavy sectors like tech and finance, they view AI integration as an existential requirement, so their IT budgets are essentially uncapped right now.
Yeah, they have to spend it.
But then consumer-facing sectors, they're terrified of macroeconomic pressure and softening consumer spending, so they're treating IT upgrades as discretionary and just cutting those budgets.
That is precisely the dynamic playing out in the top line. The aggregate demand from tech and finance is so overwhelming that it just absorbs the contraction in consumer goods, pushing the overall revenue well above consensus expectations.
But like we said, the top line only tells the story of demand.
Right. It does not tell the story of execution or profitability. And that is where the market found its reason to hit the sell button.
Yeah, let's unpack the profitability. Because growing revenue by 22% while profits drop 41% usually means a company's pricing power has just totally collapsed.
It's a huge red flag on the surface. Adjusted EBITDA came in at $19.0 million, but the margin compressed severely down to 13.3%.
Which is a steep drop from 18.4% a year earlier.
A massive drop. And overall profit, as we noted, plummeted to just $5.8 million.
If you're generating significantly more revenue but keeping drastically less of it, the financial engine is leaking.
It's leaking badly. But digging into the SG&A line, it actually looks like they are doing this to themselves on purpose.
Yeah, management is framing this not as a loss of pricing power, but as an intentional, aggressive commercial investment phase, right?
Exactly. We have to break the profit leak into two distinct categories. There's the strategic internal spending and then the external macroeconomic friction.
Okay, start with the internal strategy.
So there was a massive 45.7% year-over-year spike in selling, general, and administrative expenses alongside other operating expenses.
Wow, 45.7%.
Yeah, they spent $32.3 million there in the quarter. You do not accidentally increase overhead by nearly 46%.
No, you definitely don't. A spike like that is usually a red flag that management has lost control of the budget.
Right, but here, they are weaponizing that cash to change their entire service model.
Yeah.
They are pouring money into what they call their agentic SDLC initiatives.
Right, and for anyone who tracks the space, SDLC is just the software development lifecycle.
Okay.
But throwing the word agentic in front of it, that's the critical nuance here.
It changes everything.
They aren't just selling traditional IT staffing anymore. They're trying to sell a completely different, highly automated development process.
We really need to define what agentic means in this context because honestly, it is the entire foundation of their investment thesis.
Yeah, break it down for us.
So, for the past year, the industry standard has been AI copilots. A human developer writes code, and the AI sits alongside them, auto-completing lines or suggesting syntax.
Basically a really smart spell check for coding.
Exactly. It's a tool that requires constant human direction. But an agentic system is fundamentally different. An AI agent is assigned a high-level goal, for example, build a secure login portal.
And then the agent just does it.
Yeah, the agent autonomously writes the code, designs the testing protocols, runs the tests, identifies its own bugs, and then rewrites the code to fix them, all with minimal human supervision.
That's wild. So CI&T is spending heavily to build the infrastructure that coordinates fleets of these autonomous agents for their enterprise clients.
Exactly. They are betting that taking a massive hit to their operating margins today to build this agentic infrastructure will essentially secure a monopoly on the future of enterprise software development.
But strategy is only half the reason the margins collapsed.
Yeah.
Even the best strategic pivot gets derailed by bad macro conditions.
Oh, absolutely.
We need to talk about the external friction in Brazil. Because a tech consultancy relies heavily on geographic labor arbitrage to maintain its margins.
Yeah, that geographic arbitrage is the traditional lifeblood of an IT service firm.
Right.
You generate revenue in strong global currencies like the US dollar, but you house a massive portion of your operational costs, specifically developer salaries, in countries with weaker local currencies.
And CI&T has a huge footprint in Brazil.
And a massive footprint. And recently, the Brazilian real has been depreciating, while local inflation remains a real factor.
Ouch.
Combine that currency swing with higher Brazilian payroll taxes that were recently implemented, and the arbitrage spread just collapses.
So when the cost of your primary input, human capital in Brazil, suddenly spikes due to regulatory and currency pressure, your gross margins compress instantly.
Instantly, it is a brutal combination.
You have management actively suppressing margins by spending heavily on a new AI sales force, while getting hit simultaneously by unavoidable tax and currency headwinds in their primary labor market.
Exactly. And Wall Street looks at 4 consecutive quarters of missed bottom line estimates and concludes the company is just spending faster than it is earning.
But this brings us to the core of the earnings report, which is how management plans to actually monetize this agentic infrastructure.
Right. The billing model.
Because if AI agents are doing the heavy lifting, the way you bill the client has to change fundamentally. Here's where it gets really interesting.
It is the existential transition for CI&T and really the broader IT services industry.
Yeah.
Historically, tech consultancies operate on a time and materials model. It's very simple. You hire 100 developers for a 6-month project, and the client pays an hourly rate for every single hour those developers work.
Right. But think about the mechanics of an AI agent. If your proprietary AI system allows a developer to complete a project 10 times faster than a legacy developer, an hourly billing model would actively destroy your revenue.
It would. You'd be financially punishing yourself for your own technological efficiency.
It's like shifting from paying a taxi by the mile to paying a teleporter a flat fee for instant arrival.
I love that analogy.
Right. If a consultancy can instantly teleport a client's data infrastructure into the modern era using AI agents, charging them an hourly driving rate makes absolutely zero sense.
None at all.
You have to charge for the value of the destination, not the time spent in transit. And that is exactly what CI&T is doing by shifting toward value-based or consumption-based pricing models. They are severing the link between time spent and money earned.
And the data shows they are executing this pivot aggressively. Management actually reported that 35 to 40% of their demand now involves this agentic SDLC work.
Wow, that's a huge chunk.
It is. And 40% of their new sales in the first half of the year utilize these new value-based, output-based, or consumption-based models.
That is a massive operational shift for a legacy sales organization to undertake in just 6 months.
Exactly. They are retraining their entire commercial team to sell business outcomes rather than selling developer headcount. And the financial goal of this transition is highly lucrative. Management claims that once these value-based contracts reach maturity, they will expand gross margins by 3 to 15 percentage points.
And we're actually seeing the early indicators of that margin expansion in their workforce metrics, aren't we?
We are. Revenue per AI builder, which is their new term for developers utilizing these agentic tools, is up 7% on a trailing 12-month basis to $80.1 thousand.
So they are generating more revenue per human because the new billing models allow CI&T to capture the financial upside of the AI speed.
Exactly. But to maintain that speed, the developers need access to the absolute bleeding edge of generative AI models.
Which explains their aggressive partnership strategy.
Yeah, they recently expanded their integrations with major foundational model builders like Anthropic and Mistral AI. And this goes far beyond issuing press releases with AI buzzwords.
Right, they're actually putting it into practice.
They are. They have already certified over 1,000 of their engineers specifically on Anthropic's Claude model. They are baking these large language models directly into their delivery engine.
Because they know that if they're going to guarantee specific business outcomes under a fixed, value-based contract, their internal delivery system has to be flawless.
Yep. The AI tools are the only way to fulfill those contracts profitably without blowing up their internal labor costs.
So we have a complete picture of the transition. The major banks, TD Cowen, JP Morgan, and UBS, all took out their red pens following this report and slashed their price targets.
Yeah, they did. TD Cowen and JP Morgan took their targets down to $5. UBS lowered its target to $6.20.
But here's the critical part. None of them told their clients to sell. All three firms maintained their buy or overweight ratings on the stock. They're essentially telling us that the near-term math is incredibly ugly, but the long-term thesis is intact.
The sell-side analysts are attempting to model a company that is fundamentally changing its underlying unit economics. They have to cut the near-term price targets because the commercial investment phase is running hotter and heavier than Wall Street originally modeled.
Right. When SG&A spikes 45% and EBITDA margins compress severely, the near-term earnings multiples just have to come down.
Exactly. However, by maintaining those buy ratings, the institutional consensus is signaling that the 22% top-line growth is real, the demand for agentic AI integration is real, and the transition to high-margin, value-based contracts is a sound strategy, even if it is currently pretty painful.
So what does this all mean? Because not everyone is willing to wait out the pain. Wedbush highlighted the exact vulnerability in this transition by downgrading the stock to neutral and slashing their price target heavily to $4.
Yeah, Wedbush is pointing directly at the execution risk.
Right. It's one thing for management to declare they are moving to consumption-based pricing, but it's another entirely to convince massive, bureaucratic Fortune 500 procurement departments to change the way they have bought IT services for the last 3 decades.
The friction of legacy enterprise procurement really cannot be overstated. I mean, Fortune 500 companies are structurally designed to buy human hours. Their entire vendor management system is built around tracking tab sheets and hourly rates.
And CI&T is walking into these legacy institutions and asking them to throw away their procurement rulebook and buy AI-driven outcomes instead.
Exactly. Wedbush is simply pointing out that this educational and sales friction might outweigh the technological tailwinds in the immediate future. The fact that CI&T has missed consensus bottom-line estimates for 4 consecutive quarters just gives ammunition to the skeptics who believe the execution is faltering.
There's a very precarious gap between a beautiful strategic narrative about AI agents and actual GAAP-verified cash flow. Retail investors, and frankly a lot of institutional funds, have a finite amount of patience.
They really do. You can only tell the market you are investing for the future for so many quarters before the market stops believing in the future and demands profitability today.
Right. If CI&T cannot prove that these new AI-driven contracts are actually padding the bottom line in the next few quarters, the narrative will sour, regardless of how fast the top line is growing.
And, the struggle CI&T is going through right now forces us to consider a much larger paradigm shift that extends across the entire technology sector.
Yeah.
If this pivot to AI agent-driven, consumption-based pricing is successful, like if clients actually adopt it at scale, what happens to the traditional valuation metrics we use for tech consultancies?
That's a great point.
For decades, analysts have valued these firms based on revenue per employee and overall headcount growth. But if AI agents are writing the bulk of the code, identifying the bugs, and deploying the software, the number of humans a consultancy employs becomes entirely irrelevant to their revenue capacity. We might be witnessing the real-time obsolescence of the hourly billing model and the complete destruction of headcount as a metric for enterprise value.
Make sure you follow the show for daily earnings coverage.